So let me kick this bad boy off. As you know, we do these quarterly market economic updates every quarter with our Chief Investment Officer, Mike Horwath, the man, the myth, the legend. And we keep the format pretty similar, which is I don't talk except to field any questions. So if you have questions, just write them and I'll field them and ask Mike. He has a presentation he'll go through. Of course, if they're very personal to your finances, just reach out to your advisor. But if they're sort of on topic, feel free to ask and I'll field them accordingly, appropriately as we have time. Other than that, we keep these pretty truncated to 30 minutes. So Mike will go through it over the next 30 minutes or so. We'll end it. We will send this around. So if you have to jump early or want to share it with friends, colleagues, whomever, feel free. And I guess that's it. So once again, I'm Andrew Rosen. I'm the president of this little financial planning company and tax company we now run. And I'm excited to learn from Mike Horwath as well. So with that, Mike, I will mute myself and let's educate us, would you?
I'll do my best. Thank you, everybody. Happy New Year. Welcome to the 2023 year in review. So as Andrew said, just a couple of housekeeping items. We typically like to leave these about 25-ish minutes of prepared material with 5, 10, 15 minutes of Q&A. Try to keep it to 30 if we can. But I will say, if anybody, look, if we can't get to it today, or maybe we don't get to your question, or you want to ask it separately, as Andrew said, feel free to reach out to your advisor, reach out to myself. We're here to help answer any questions, or especially make sure we're alleviating any concerns you may have, or addressing any concerns or thoughts or items like that. But with that said, it's the calendar has turned. We're in 2024, and let's kind of look back at 2023, because while it feels like we ended on a very positive note, and in a lot of ways that is true, I think it misses some of the bumps along the way, and I think there are things that are worth highlighting and things that are worth discussing. So I do have a webinar, or sorry, a newsletter coming out here in a day or two that'll say a lot of the similar content, right? We'll go through similar things in a much more written form, a little bit more detail, and I named it "Embrace the Uncertainty," right? And I think the important part is, with investing, with markets, there's always uncertainty in so many parts of our life. But now, just like every other time, it feels like there is so much uncertainty on how we move forward from an economic perspective, a market standpoint, geopolitically. There are a lot of things out there that kind of overhang the uncertainty of us making decisions for portfolios and financial planning. But I think it is important that we embrace what that uncertainty is, and we try to help kind of make better decisions as we move forward. And that's a lot what the newsletter is trying to go through. And a lot of that will kind of stem through today. So as we look through 2023, really the main themes, if we look back, inflation is starting to take a backseat. The focus is really mostly on the Fed, what they're going to do, and then really what happens from an interest rate tied to the Fed, and then a growth perspective. Right now we're shifting from inflation's a major concern to now inflation's coming under control. It may not be at target, it's getting closer, but now we're much more focused from an economic growth perspective. So if you remember 2022, the Fed raised rates up to about 4.25%, I believe it was, right? So it was a very, very rapid hiking cycle in 22. We all remember the kind of the pain there. In 2023, they continued to raise rates, which was something we expected. They raised it about another 100 basis points, up to 5.25%. And we saw them pause after the July meeting. So after the July meeting, they did not raise, nor did they cut rates for the remainder of the year. They kept them at that 5.25% and 5.5%. And what you've seen are really these fighting forces of, what does this mean? What does it mean on a forward-looking basis? What's the Fed going to do? What do corporate fundamentals look like? And what we see is corporate fundamentals remain really strong. Growth remains strong. We're going to go through each of these kind of in more detail, but earnings remain strong. You can see on the right-hand side of the screen, profit margins, while they've come down from those peaks that we saw really in 2021, they're still pretty high historically. So margins remain strong. You look at earnings, like I said, they remain strong. Growth was really strong, very resilient. And the market, from what we saw from pretty much August through the end of October, where markets pulled back quite a bit, where all of a sudden you saw a lot more volatility, a lot more hawkishness in markets, to the last 2 months, which were this big reversion in performance. It was broad-based. You saw bond yields come down. All of a sudden, markets starting to price in different narratives. And we can go through that in a little bit, but it was a bumpy year, right? And if you look back, you look at just the numbers at the end of the year, it would tell you that it was a great year, but three major regional banks failed. We had this AI boom, which was on the positive side. Rates were moved up to 5.25. We have two major geopolitical conflicts going on. There's a lot happening. So we don't want to lose that detail and what that means coming out of 2023. Just a revisiting of asset class performance. I highlight the major ones that we want to focus on for 2023. It was a pretty positive year across the board, which is a great thing, right? Coming off of a 2022 where we saw both stocks and bonds down double digits. Well, for 2023, it was a bounce back year where we saw equities up over 20%, which was great, and we saw fixed income measured by the U.S. bond index up 5.5%. Right. One of our predictions that we'll go through from 2023 was that fixed income would have a bounce back year. And candidly, through October, that didn't look so much like the case, where fixed income was actually negative through October. Well, the last 2 months of the year had a great run. November was one of the best months in the Barclays US Ag Bond Index since the 1980s. So we ended the year at 5.5%, but both stocks and bonds had a really nice, solid bounce back year. And as we kind of looked at 2023, we expect some of the same for fixed income. Equities, I think, are going to be a little bit choppier. It's going to be hard to sustain that type of return, but we can kind of dive into kind of what's happening and where we kind of see the opportunity. But going back to interest rates, because I think this is a good place to start of what's happened. And you can see the fluctuation over the course of the last 20 years. It's no surprise that the Fed goes through these hiking cycles and then cutting cycles, right? As growth picks up, inflation picks up, they hike rates. Recession typically happens, they cut rates. You go through these cycles, and you can see where we're at in the red circle. We're at probably an inflection point. You see where we stand today, right around 5.25 to 5.5, right? That's the range that the Fed uses for its Fed funds rate, the short-term interest rate. But what you see is that the blue line and those diamonds represent the Fed's expectations for where they're going to land the next couple of years. And then what you see in the green line, the dashes, is where the market is pricing in the Fed's going to go with interest rates for the next couple of years. While there is certainly some disagreement, and I think that's an important distinction, what you see is it is a downward trajectory. I think it's pretty safe to say that the Fed, barring anything major unforeseen happening, is likely done hiking rates. The focus now is how long do they maintain current levels? When do they start cutting? And what's the magnitude of those cuts, right? Those are the questions we have to ask. And that's really the dynamic that the market is currently playing out is what does that look like? And there's a difference, right? I think from an asset management perspective, the way we look at it is, we know rates are going to get cut. That doesn't mean you should just add a bunch of duration because rates are going to get cut. What it means is, what is the market pricing in this going to happen versus what is the Fed saying? What's that difference, and what do we believe is going to happen? And that's where we see the opportunities, and that's where we have to be able to react to market pricing and market changes over time. This has been the story, right? When we go back to what happened in 2022, this was the major story. You see the gray line for December 31 of 21. We had a normal upward sloping yield curve, right? Bond yields were very, very low. And all of a sudden in 22, you saw over 400 basis points of interest rate increases up to the green line, inverted yield curve where the short end is higher than the long end. And then in 2023, the short end continued to move up, which is not a surprise because the short end is driven by the Fed. The long end, really the middle to the long end, really stayed the same for the course of the year, but still an inverted yield curve. Now, you'll typically hear that phrase because an inverted yield curve has almost always preceded a recession. It's very common to precede a recession. The question is, can the Fed orchestrate uninverting, right? So getting back to an upward sloping yield curve without pushing the economy into a recession. That's what they call a soft landing. And that's really what the market over the last 2 months had started to price in, is the likelihood of that happening becoming higher, that they can get inflation down to target, bring bond yields down, right? Bring interest rates down without having to push the Fed or the economy into a recession, nor worrying about inflation picking back up, right? That's what would be called an ideal scenario of a soft landing. Where does growth go? Because this is what it turns to, is what happens with growth. If you look on the left-hand side, I highlighted the US and what expectations are and what actually happened in 22, 23, and what's expected to happen in 24. The gray bar is 21, really, really strong growth for 21 coming out of the COVID situation. You see the blue line in the middle of 22, positive, above 2% annual real GDP growth. And then 2023 projected to be another solid year. And I think what surprised a lot of people was the strength of the US economy for 2023. What I think that also means, though, and you're going to see it on the right-hand side, is for 24, which is on the right-hand side of that, the red shaded box, is growth is likely to slow. We would expect growth to slow. And really what it probably means is that some of that growth we expected for 24 got pulled forward to 2023. So you'll see the growth expectations on the right-hand side with the gray bar, how that was the expectation over time for 2023 GDP growth. And you can see going into the year that you were looking a little bit above 2%. And over the course of 2023, that expectation just kept climbing, while that blue bar started to decrease over time. You know, not to a huge magnitude, but really what that means is some of that growth was getting pulled forward into 2023 rather than 2024. The good news is that expectations aren't for a recessionary environment. That shouldn't necessarily be your base case. I think the risk is still there, but even so, even if there is a recession, there's a technical recession, there's enough economic backstop and strength out there that we don't expect it to be any sort of severe recession. It'd be more of a mild recession, pretty short, 2-3 quarters worth of negative GDP growth before kind of recovering and kind of moving forward from there. This is a big story because inflation dominated 2022. We spoke about it for nearly every quarter for probably the last 6 quarters. What's going on with inflation? What does it mean? And really what you see is both core CPI and PCE, right, which are just 2 different measures of inflation. Both are closely aligned. There are some nuances to both, but the main story is core inflation has peaked, has been coming down methodically, and while it's still above the target rate of the Fed, it's still a little bit above 3%. It's certainly getting closer to that 2 to 2.5% range that we would expect from markets. The other big part is that what we're seeing is that there's easing amongst some of the underlying components. Because if you look at how CPI or PCE are calculated, and you look at how shelter, right, rents and housing prices are built in, there is a big old lag there for when those prices get built into the models. So we're starting to see, especially rental prices, which really rose and have plateaued and have eased quite a bit. Those are starting to get built in. So you do start to see underlying support for core, both CPI, right, Consumer Price Index, and PCE, the Personal Consumption Expenditures Index, both of them easing. And we do expect those to they may plateau. It wouldn't be a surprise if they plateau in that 3% range and kind of struggle to get down to 2%. But it's certainly on the right path. We're not at that 5-6% annualized year-over-year GDP number that we had seen not that long ago, going back into 2022. So inflation, I think, is starting to go into the rearview mirror, which is great from an economic perspective, because it lets us focus on how we can move forward beyond inflation. It lets the Fed kind of focus beyond what they've been doing for the last, call it 18, 24 months of their hiking cycle. On the equity side, if we kind of dive into what happened within the equity markets and what it looked like, it was a very narrow market. And I think people have lost that perspective of what worked in 2023. I would say it's probably the year of narrowness, if you want to call it something like that. The Russell 1000 growth versus the Russell 1000 value, there's a 30-ish% differential between the two. The S&P 500 to the Russell 2000, right? That's large cap to small cap, a 10% difference. The Russell 3000 to the ACWI ex-US, that's US to international, 9-ish% differential. The tech sector versus utilities, that's over a 60% differential. So what we saw was it was a pretty narrow market of what worked. There's always going to be winners and losers in every given year. But what you saw was growth to value, large to small, US to international. It was a one-trick pony in 2023, and it really focused around the Magnificent Seven tech stocks, right? So the Magnificent tech stocks, they're the biggest 7 names really in the country: Apple's, Amazon, Alphabet, which is Google, Meta, which is the old Facebook, Microsoft, Nvidia, and Tesla. What we saw was those names drove nearly all of the return for 2023. And in many ways, it makes sense. A lot of these companies are some of the biggest, the best, most profitable, biggest margins, some of the strongest pricing power companies in the world, right? Not just the US, in the world. So in some ways, it makes sense. In other ways, it kind of shows that the market wasn't as strong as it necessarily felt during the year. It was narrow with what worked. The other 493 equities in the S&P 500, or the other thousands of names globally, did not drive returns nearly to the extent that those 7 tech stocks or 7 biggest names drove for 2023. We expect that to start to reverse itself in some ways. And there's a couple of reasons why. It's not a bet necessarily against those companies, but it's just a widening of what's working, and starting valuations matter. Right? Price matters. Some of these names have gotten very expensive, and what's priced into them may be unsustainable over the course of a long time from a growth perspective. Very narrow. And in fixed income, I think it's important that if you look at what happened in 2023, coming off of 2022, it was largely expected, right? At least from our side, we're not surprised by this bounce back year of 5.5% on the US aggregate, over 6% in the muni market. A bounce back year in fixed income, just because what happened in 22 was so drastic, where markets pulled back in fixed income, yields rose, that even if interest rates rose, think about this. People were so worried about interest rates rising, and that how can bonds perform if interest rates rise? In 2023, the US Ag was up 5.5%, and the Fed raised rates 100 basis points. And it shows that starting yields matter. And even if interest rates go up, it doesn't mean that bonds can't perform well. But what happened in 22 was so drastic, and the starting place was so low, that it was very difficult for the global bond market to perform well in that type of environment. But you can just see the extreme level what happened in 2022 on this screen, of the gray bars being the annual returns for the bond market. But it was a nice bounce back year of nearly 6% for the US aggregate bond index of about 5.5%. And it shows how stable the fixed income world has been over the course of the last 3-ish decades. In the last 48 years, annual returns for the US Ag were positive in 43 of them, right? Only 5 were negative. It just shows the stability and what happened in 22. Not that it can't continue to happen at other points in time, but how drastic that was and how unusual it was of a year. I spent some time on this on the newsletter. I think making predictions for any given time is useless if you don't revisit them and hold yourself accountable to some extent, and just really try to learn from them, right? Why did we decide what we did? Why did we think what we did? And how do we do? So if we review kind of what we went through in 2022, in December of 22, when we put out our predictions for 2023, we said inflation would moderate but stay above target. I think that was pretty straightforward. With the Fed raising rates the way that they did, inflation was going to come down, barring anything extreme happening. And inflation did moderate. It did not get to target. It may still be another year before we get to target, but it moderated quite a bit. We believe that the Fed would stop raising interest rates in early 2023, which I think we were a little bit more optimistic on than what actually happened. They paused in July, so they probably did one additional hike than we would have expected. But by and large, they looked at it. They got 4 interest rate hikes on the books, up about 100 basis points, and then they paused and let the data come in to make that final decision of, do we need to continue to raise interest rates, or do we feel comfortable that we've gone far enough and need to let this work its way through? The third one was the one where I think we look back on with kind of the biggest puzzle from our side. And I think it's probably something that's industry wide, of a technical recession being more likely than not. Growth was very, very strong and resilient in 2023. And if we learned anything, it was, if you give enough time for businesses to prepare for higher rates and for potential slowing growth, that companies can do a really good job insulating themselves and protecting themselves. And as long as there's no major shock to the system, they can hold up pretty well. And we did not see slowing growth in any way. I do think 2024 will have some slowing of growth, but there's enough strength underneath the hood from a consumer perspective, which, may slow, but margins are still strong. Earnings are still strong. Top line pricing power may ease, of course, but by and large, we still expect growth to remain okay. And even if we do dip into a recession in the early to mid part of 24, we don't expect anything severe. It'll likely be just some slowing on the growth side. The fourth was, we expected unemployment to weaken. Part of this was kind of a layup. Unemployment came in at 3.5% for the year, at the beginning of 23. So candidly, there wasn't much more downward it could go. But unemployment was likely to rise, but we didn't expect it to be anything drastic. It went from 3.5 to 3.7, which is probably even lighter than we would have expected. We would have said probably closer to 4 for the year, but unemployment weakened a little bit. Is something to keep an eye on, but the labor market remains really strong, both in 23, and we do think 24 will remain that way as well. And then the big one was, we also thought fixed income was going to bounce back from a really, really rough 2022. A lot of individuals looked at the end of 2022 and said, why should I continue to even own fixed income? And, we kind of sat there and we were maybe a little stubborn about it, but it still holds its place in portfolios for a specific reason. We looked at it and said, we like the way it looks moving forward. Returns are now expected to be higher. Quality from a leverage perspective for businesses is really strong. It's still going to do what you need it to do. I know it's hard to stomach after 2022. And it did. It bounced back really well, 5.5%, like I said, on taxable bonds. High yield bonds did really well. They were up low double digits, around 12, 13%. Corporate bonds were up, investment grade were up almost 8%, over 8%, I believe, is in 2023. So it was a bounce back year across the board for fixed income, and something pretty strong to kind of bounce us into 2024. So what are we looking at for 2024? What are our kind of predictions? And I'll go into depth in some of these a little bit further in that newsletter that comes out here shortly. But one, rates are going to go down. I don't think we're going out on a ledge here in any certain way, but rates are likely going to come down. The Fed predicts it. The market's predicting it. The question is, what's the magnitude? I think rates are going to come down less than what the market was pricing in. They were pricing in upwards of 150 basis points of cuts. I think that's quite aggressive. I think the Fed's prediction closer to 75 to 100 probably makes more sense. And I think that would be our expectation for 2024. Rates are going to come down for 2024. I do think bonds continue to have another good year. I would expect on a forward-looking basis that bonds have similar experience that they had in 2023. While most of the cutting is already priced in, starting yields matter. And a lot of these investment grade fixed income securities are yielding 5+%, 6%, 7% in some areas. With the right oversight of fixed income, it can continue to be a good diversifier in portfolios, but more importantly, add value to your portfolio. I do think returns will be less concentrated. In my newsletter, I've kind of said that I think an equal weight index will outperform the market weight index because I think that the market will broaden out in what's additive to portfolios. And I think those top names have gotten too concentrated. And I would take an equal weight over a market cap weighted, which is an opportunity for some small cap names, for some other areas of the US large cap, and even in some spots in international to finally drive performance beyond just a couple of names in portfolios. I don't expect inflation to be a major headline. I think that plateaus. I think a lot of those components have come down. I think goods pricing, if you look at it, goods inflation has come down virtually to zero. And what you're seeing are the service side of the market coming down quite a bit as well. And I do expect inflation to really start to take a rear view seat, or a back seat to everything else, right? Growth, unemployment, earnings, and all those other components of the economic side. And then the last piece is less of a prediction, but it's more of a kind of a public service announcement, is that we have an election year and it is going to be painful. 2020 was painful. 2016 was painful. And when I say painful, I mean it from the perspective of market headlines are not fun. You will get predictions from all angles. There will be headline risk everywhere. It will be difficult for investors, as always, to kind of check emotions at the door. Our job is to kind of keep everybody grounded into what matters and what doesn't matter. But there will be a lot of headline risk, and we'll look back at 24 and be able to point to all the articles and the headlines of how scary things are, how the world's ending, and all things like that. So election years are not fun, but we have to deal with it, and it's an important part of our process. And we will be here to help everybody kind of get through that. So if I look to 2024, kind of what those potential opportunities or tail risk would be, right, on both ends of the spectrum, just the potential opportunities continue to be corporate fundamentals are really strong. It continues to be the best part of the market, where we think about leverage being low. Companies really refinance themselves into a really good spot coming out of 2020. You look at earnings, you look at margins, all really, really strong on the macro side. There's certainly going to be areas of strength versus other areas of the market, sectors by sector, but overall corporate fundamentals are strong. The labor market continues to be strong. I think just the economic backdrop is in a really good place going into 2024, given everything else going on, given where rates have risen to, given how strong they've been over the last several years. So I think that is a really good opportunity, and the ability for markets to continue to remain pretty strong. And I think naturally that there are tail risks, right? Elections always bring tail risk. It's not just the US. I think I saw the stat. It's 50% of the world's GDP is undergoing an election in 2024. So elections are going to have a big place politically for 2024. I think US debt levels are naturally a tail risk. I think it's less of a 24 issue, but I start to think and see the numbers of how much US debt levels are increasing at increasing interest rates. It will need to be addressed at some point. And naturally, they have two major geopolitical conflicts going on that can always escalate beyond just two. Those themselves can escalate. That is always a tail risk that we're keeping an eye on for sure for our client portfolios. Just real quick, as we move forward, what are we doing from a positioning standpoint? I think a lot of this has continued to maintain over the course of the last 6 to 9 months. Is we're still overweight the US over international. We still see more opportunity here in the US, although it's more expensive. I do think that's something that we have to acknowledge, but the opportunity set in the US is better. We do have pieces in our portfolio, though, that are hedging some of the downside, and we can certainly talk to anybody on that who has specific questions. But we do continue to have tactical allocations to the semiconductor industry, which is the chip industry, and the communication services sector, right? We see value in the Googles and the Metas. If we're going to be in those big 7 names, I think those areas are still the most attractive from our side. On the bond side, we are primarily up on the capital structure. So what that means is we prefer investment grade right now over high yield. High yield can add some value if it's done right, but you're not really being compensated very well to own high yield in some of the junk bonds, and the spreads are tight, so there's just not much room for growth, but the yields are nice. So we look at it, and we do want to maintain a pretty heavy core allocation to treasuries and mortgage-backed securities, investment grade corporates. And we're pretty neutral to duration. I think everybody thinks you want to be very, very short term with short term rates where they're at. When rates peak, it is actually a much better historical outcome if you extend duration and add to the duration side, right? Extend a little bit farther. And then the last piece is really just a couple of tactical pieces within fixed income, right? To commercial mortgage-backed securities. That's just the debt side. We see some value within areas that are outside of the office space. And like I said, we've added to duration. If you look back to some of the changes we made at the end of October and into this or November, we made an adjustment to go longer duration. I think that is something that we really do value, and we think will be a good play as we kind of continue to move forward. So I went through a lot, and hopefully I'm on time. But Andrew, I want to turn over to you. If there's any specific questions, I'm happy to go through or take them offline and respond individually.
Yeah, we did have one or two. I sent them along to Kyle to reach out to you, Mike, since I know we are short on time and I want to keep this to our 30 minutes. So we'll, as always, happy to answer any questions. A couple of you that asked at the end there, we'll circle back accordingly. But Mike, awesome stuff. Educational as always, informative, insightful. I don't know if I have any other adjectives.
No, keep going.
Use.
Keep going.
But we appreciate it. We appreciate all you, our clients, for your trust in us, and you can see some of the talent we are proud to bring to the table to help you achieve your lifelong goals. So, as always, I'm Andrew Rosen, Mike Horwath here, our CIO, and we look forward to doing this again in a couple months and seeing what plays out. So, Happy New Year, everyone. Take care, and thank you for listening. Bye.
Take care.